Schulz, he's an economist at Berenberg Bank, joins me in the studio now. And I guess that rating cut from S&P essentially underlines Spain's biggest challenge, its biggest obstacle right now, the banks.
Well, yes, but the question is, are the banks the problem, or are the banks a problem because the sovereign is a problem? We think that the real underlying problem remains the sovereign and the missing commitment that the sovereign will not go bankrupt by Germany and by the ECB. And for that commitment to be effective, we need more austerity, and we need especially the fiscal treaty that the countries have signed but have yet to ratify.
So does that mean you think that the banks will need recapitalization in the next few months or at some point this year?
Well, the banks will probably need recapitalization, although it seems that the Spanish government has a difficult time in convincing the banks to actually raise money or take money from the public sector, because the banks seem to think that they can still deal with this problem by themselves. But in any case, this is credible only, this recapitalization by the state, if the state itself is solvent and if the state itself is liquid. And that depends on the markets, and the markets are closely watching whether there is enough support from Germany and whether there is enough support from the ECB for Spain to remain liquid and solvent.
So that means that if they do need further help at some point, further support, that it'll have to come from Europe, from the EFSF?
Well, if they really run out of money, if they really face a buyer strike at their auctions, which so far they haven't, and the yields at the moment are still not unsustainable, if they really face that buyer strikes, there are all the tools.
You're speaking about Spanish borrowing costs now, yeah.
Spanish borrowing costs. If Spain really needs money, all the money is there. The rescue fund is big enough. The ECB has shown before that it's ready to commit to saving Spain and other countries. It's all there. It's just that at the moment we're in this position where the Spanish don't want to take the money, where the Europeans feel that not enough has been done possibly, and we're sort of in the balance at the moment.
How does that reach its conclusion? Because right now, I mean, we're seeing, just taking a look at Spanish long-term debt there, we did reach 6% at one point. We've come away from that level, but nevertheless, there does seem to be this belief in the markets that Spain is going to struggle to implement its reforms. We were just seeing pictures there of protests across the country just yesterday, and ultimately this belief that they will not be able to meet their deficit targets.
Well, irrespective of what happens on the markets and what happens with the funding and what happens with the banks, Spain needs to do its reforms. That's the key. It needs to do the austerity reforms, of course, but especially the structural reforms. They've had a very good start with the labor market reforms. Probably a lot more needs to be done. They've also set out to do these things. If they do these reforms, they will have a negative impact on GDP, on growth, on jobs and all that. But they will save the credibility of the country vis-à-vis its European partners. And that's the key for Spain. They can go through this period.
So it's
if they
worth
got
sacrificing the impact, it's worth sacrificing growth or GDP to an extent if it means that they get to maintain some credibility with their European markets, and the hope is ultimately in the markets as well.
Well, exactly. But I mean, one thing we see is that there is a negative impact on GDP from these austerity measures. That's clear. But there's at the same time, Spain is gaining competitiveness. The external demand that Spain is opening up with its improvement in competitiveness already shows in the figures that we've seen today for Spain. The recession is far less deep than otherwise would have been, because external demand replaces a lot of the domestic demand.
Will Spain avoid a bailout?
Very close call. The nervousness in the markets is there. We could see, at the moment, there's only domestic banks buying the bonds in the auctions. They might at some point either decide otherwise, or they simply run out of liquidity. If by that time they haven't managed to get the credibility back with international investors, and especially with European investors, then they would face a bailout, clearly.
And if Spain continues to make progress on its reforms, you're quite positive on what they've done so far. If this were to continue, if they were to rebuild their credibility in the markets and with their European partners, as you say, would the ECB perhaps take further steps to loosen monetary policy with Germany's blessing?
Don't think so. Germany really respects central bank independence. You will never hear much from Germany on the ECB's policy, other than...
No, but we know where they stand, right?
But we know where they stand, and there's worries about price stability and all that in Germany, clearly. But the ECB will look at Europe as a whole, and right now they have a focus on the weaker countries. If necessary, they surely would do something, but for the time being, it doesn't look as though the ECB is convinced that there's an urgent need to do something, especially given that many countries still have to reform themselves.
So we're unlikely to see, do you think we'll see further rate cuts this year?
No, that's not our main scenario. Our main scenario is that the ECB keeps interest rates at the historic low until the end of the year, and then depending on how the situation works out, our main forecast is that Europe returns to growth by the end of the year, and that means that the ECB will next year look at rate increases rather than rate cuts.
Christian, we have elections coming up this weekend. It's going to be a busy one with both Greece and France going to the polls. We've already heard from François Hollande really emphasizing more of a growth agenda. He's spoken about the need to renegotiate the fiscal treaty. What could this potentially mean if he were to win the presidency? How could this impact his relationship with German Chancellor Angela Merkel? Does he risk getting off on the wrong foot, or is this just campaigning rhetoric?
Well, it is, of course, campaign rhetoric, but it's quite striking that even though he's on the campaign trail, a compromise already seems to be emerging with Germany. We've had both him saying that the European Investment Bank needs more money, and we've seen Angela Merkel over the weekend say in a newspaper interview almost exactly the same words: yes, the European Investment Bank might need more money. So it seems quite likely that we have a compromise emerging where the fiscal treaty is signed and ratified by everybody as a long-term goal, and where in the short term Europe supports growth with increased funds, for instance, for the European investment banks, plus, of course, the structural reforms which are necessary.
Christian Schulz, economist at Berenberg Bank. Lovely to have you on the programme.